What credit score do you need to buy a house? Well, it depends. In today's video, I'm gonna go over how much of a home loan you can get with a 650 credit score, how to improve your credit score, and what is the minimum credit score to buy a house. Hi, thanks for watching today's video. I'm Tristen Campanella. I'm a local San Diego realtor, and people contact me all the time. Make sure to text, email, or call me when you are ready to talk about buying a home in San Diego. There's never any obligation. It's just what I love doing. Okay guys, let's get into it. So credit score is an important consideration when you're buying a house because it shows lenders your ability to pay off debt. A credit score of 620 or higher should allow you to qualify for a mortgage, but government-backed loans may allow for even lower scores. The higher your credit score, the more favorable your terms will get you on your mortgage. The kicker is that once you buy a house, your credit's gonna go up a lot. So sometimes just getting into a home at a higher mortgage rate amount and then refinancing in 6 months or a year may make sense. Let's dive in and look at credit score and the credit scores you're gonna need to buy a house, which loan types are the best for certain credit ranges, and how to boost your credit. Your credit score is the number that ranges from 300, which is terrible, to 850, which is amazing, and it is used to indicate your credit worthiness. Several factors are evaluated to determine your credit score, and conventional and government-backed loans have different credit score requirements. Confusing? A little bit. Conventional loan requirements. Okay, it's recommended you have a credit score of 620 or higher when you apply for a conventional loan. Anything over 700 and you are golden. If your score is below 620, you're gonna be offered a higher interest rate. Jumbo loans, you need a minimum of 700 to get a mortgage that's larger than the conforming loan limit, better known as a jumbo loan. Most lenders want to see a credit score that's north of 700 or even 720 because they're lending you that much money and it's inherently risky. Lenders look for home buyers to have solid financials, including a strong credit score. With a FICO score of 740 or higher, you're likely going to get the best jumbo mortgage rates ever, and using a mortgage calculator provided below can make you even clear on how slightly lower rate can make a big difference in your monthly payments. FHA loan requirements. If you have a lower credit score or just need to get in a house, or you don't have very much money socked away for a down payment, you can consider an FHA loan. This is insured by the Federal Housing Administration. The minimum credit score for FHA is usually 580, so it's really forgiving. VA loan. VA is government-backed loan and is an option if you're a veteran or qualified service member or spouse. There's no industry set minimum credit score, but Rocket Mortgage requires a credit score of at least 580 and some will go down to 560. What is a credit score versus another, like a credit score? There's so many different ones. There are 3 national credit reporting agencies: Equifax, Experian, and TransUnion. They all collect information from banks and lenders and other companies and compile that information to formulate your credit score. There's lots of ways to calculate your credit score, but the most sophisticated, well-known scoring models are the FICO score. And sometimes you'll hear something called a Vantage score, but not so often. Most lenders are gonna look at the FICO score. The following factors are taken into consideration to build your score: whether you make your payments on time, big one right there, how you use your credit, if you are extended or using it smartly, the length of your credit history, your new credit accounts, the types of credit you use. So how do you increase your credit score before buying a house? If you want to qualify for a loan and your credit score isn't up to par, you can take some actionable steps to increase your credit score. One of those steps is to start to pay your bills on time. And if you'd like, we can help you review where your credit is so that we can give you a plan. Tip 1, pay off your outstanding debts. One of the best way to increase your credit score is to determine any outstanding debts you owe and pay on it until it's paid in full. But listen, do not pay off your credit card all the way. Keep some credit going. They like to see that. your overall debt responsibilities will go down, and then you have room to take on more, which makes you less risky in your lender's eyes. Lenders are also looking at something called a credit utilization ratio. It's the amount of spending power you use on your credit cards. The less you rely on your credit card, the better, and you can get your credit utilization simply by dividing how much you owe on your card by how much spending power you have or the limit. You can also increase your credit utilization by asking for credit limit increases. For example, if you typically charge $2,000 a month on your credit card, divide that by your credit limit of $10,000 and your credit utilization would be 20%. Tip 2, pay the bills on time. Huge. A large part of what a lender wants to see when they evaluate your credit is how reliably you can pay your bills. This includes all your bills, not just your loans or your mortgages, but your utility bills, cell phone bills, they all matter too. If you have a late payment, you can write to the credit card bureaus and request them to take it off. We can help you do that. Tip number 3, don't apply for too much credit. Resist any urge to apply for more credit cards as you try to build your credit, because this puts a hard inquiry on your credit report. Too many hard inquiries negatively affect your credit score. Some other considerations when you're buying a house is the credit score is just one of the things they're going to look at, okay? So they're gonna be looking at a couple of things for you. They're gonna be looking at things called debt to income ratio. What's that? Your debt to income ratio, or better known as DTI, is the percentage of your gross monthly income that goes to paying off your debt. Again, having less debt makes you less risky to the lender, so the less DTI you have, the better. This means you're able to take on a bigger mortgage and you seem more solid. To find your debt to income ratio, divide the amount of recurring debt, like your rent, your car payments, credit card payments, that you have by your monthly income. So here's an example. If your debt is $1,000 per month and your monthly income is $3,000 a month, your DTI is $1,000 divided by $3,000, or 0.33, or 33%. It is to your advantage to aim for a DTI of 50% of lower. The lower, the better, and that will also help you get a better mortgage rate. What if you don't have a high enough credit score to buy a house? Well, having bad credit or no credit, which I've seen, may mean you're unlikely to get a mortgage unless you know someone who is willing to help you out. Having a cosigner who has a better credit score could help you secure the loan. Make sure to check out the loan calculator link below and reach out to me about what it takes to be a cosigner or have a cosigner. Guys, I made a video on loans and new FHA loan limits that are really going to help our first-time home buyers, and I thank you so much for watching.